everyone. Welcome to GTM's Tax Automation series on OneSource tax provision functionality. In this quick session, we are going to go through the difference between entering PERMs or tax adjustments as P&L entries versus entering them as tax equity entries. So if you just jump into the software, we're going to go directly to the review and edit screen within my data set. And I already have some adjustments that I entered into the system. So when you go into the software and enter a permanent adjustment or a tax adjustment, there are two options you have to type. And one is to enter it as a P&L adjustment. The other is to enter it as an equity adjustment. So when you do that, what does that look like? So I have a quick sample here that I want to show you. So for my P260 stock options, I entered a $10 million entry. As you can see, that gets included in your tax calculation. It also goes into your return basis provision. And as you know, the return basis provision also flows through to the payable report. However, for equity entries, those do not run through your tax expense account. So what you'll see the software doing is reversing the impact of that so that it does not fall into the calculation for your current federal tax provision calculation or your state calculation. So you can see down here, I also have an equity adjustment adding into my state line of 630 million. So I expected that when I took that 10 million and multiplied it by 21%, I have a $2.1 million tax effect. And what you can see is that the state also had an impact because this flowed through to the state. And the federal benefit of that $630,000 is 132. So if I add that to this number that's showing up for my federal and add the two, I will be back to my $2.1 million adjustment that I expected here when I took the 10 million and multiplied it by 21%. You will also notice down here that I had a miscellaneous adjustment, which you can see here of 150, that is also coming out as well because it was entered into the software as an equity adjustment instead of a P&L adjustment. So the difference really is what impact does the entry have on your tax expense? And for P&L entries, they impact both your tax expense and your receivable payable. But for entries entered as equity, they will only impact your receivable payable entry. Hope this was helpful. Look forward to seeing you on another session.